Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited to be joined today by a return guest, Neal Bawa. Neal, welcome back to the show.
Thanks for having me back on. It's fun to be back, and talking about one of my properties is obviously one of my favorite things to do.
Well, we were doing a lot of discussion before the show about real estate, and I was like, Neal, we got to get to recording. So
Yeah, I know.
share the details here. But before we dive into those details of Midtown Ridge, 194 units in Chattanooga, Tennessee, tell us a little bit about yourself and how you got into the multifamily space.
Sure. I'm a technologist, data scientist by profession, computer science degree. Had a successful tech career, ran a company for 14 years, sold it to a private equity firm. And while I was doing that, because I live in California and was paying 50+% taxes, I was buying lots and lots of single families, duplexes, quadplexes, sevenplexes for myself and my family, no investors involved. So decade one was buying lots of single family and also building corporate campuses for my company. And that's why I have development experience. And then decade two, finally, when I sold that company, I had a huge tax bill. So multifamily was a fantastic way, especially as a general partner, to defray those millions of dollars in taxes. And that got me in there in 2014, so 10 years ago. And since then, it's been a fun ride. I publish a very, very large amount of data science on real estate. We publish, each month of the year, about 25,000 nerdy, geeky investors that like that data science, follow it, and roughly 4% of them, about 1,000, have invested in our projects. About 300 million invested. Used to be $1 billion in value. Now I call it 700 million because I think the value's dropped by about 30%. Half of our portfolio is value add properties. The other half are new construction apartments or new construction townhomes for rent.
Oh, well, that's amazing. Well, in one of those value add properties we're talking about today, Midtown Ridge, 194 units in Chattanooga, Tennessee. Neal, when did you close on this property and what was the purchase price?
This was a recent close. The purchase price was 29.6 million. And 194 units. So if you think about it, roughly a little over $140,000 a unit. The property is in a good location, a good submarket. That's actually a fair, a significant number of dollars for a property that is in Chattanooga, Tennessee. But great bones, mid 80s property. I think it's a 84 built. It might be 89, 80, 84, I think. So built in 84, mostly brick, which I like because I like that brick facade feel on a property. I enjoy that. So it's got lower floor is brick, and then the upper floor is stucco. What I really like about the property is not so much the property, it's the fact that I know quite a bit about Chattanooga. So I don't have a property in Chattanooga, but I have a property in Dalton, which is a suburb of Chattanooga. So for those that don't know Chattanooga, it is the third or fourth largest market in Tennessee, depending upon how you measure things. And our company currently, and we basically we make fundamental tenets or assumptions about the market. We publish those tenets because other people give us feedback and tell us when we are wrong. And so our current tenet is this, that the primary markets in the United States, or I like to call them gateway markets, Whitney. So, the Bostons, Los Angeles, San Francisco, the super big markets, New York. There's no current value left in these markets. That's our first fundamental tenet. The primaries have lost the real estate value that they used to have. And I think that all of the primaries are going to suffer. The secondaries are fine. And so when I talk about secondaries, there's big secondaries like Atlanta, 5 million, 6 million people, Phoenix, 5 million people. There's a lot of these kinds of bigger secondaries. And then there's smaller secondaries, Raleigh at 1.7 million, Charlotte at 2.7 million. There's a number of those. Kansas City and Indianapolis are 1.7 million each. So there's a bunch of secondary markets, and I like secondary markets, and I invest in secondary markets. But our fundamental belief is that before COVID, we were talking about, money fleeing from primary markets into secondary. So, Phoenix and Atlanta and Dallas and so on and so forth. But after COVID, we believe that the money is now fleeing secondary markets into the third market in a particular state or region, right? So whatever that third market is actually seeing more money, coming in. So if it's Arizona, it's no longer Tucson that's the second market, it's Flagstaff. If it's Tennessee, it's no longer Nashville or Knoxville, it's Chattanooga. And so the 500,000 to 1 million person markets, and Flagstaff's a little bit small for us, so we haven't chosen to invest there, though we can see the money going into that market. What we like is a market that's a 500,000 person market, because smaller than that, just the risk, keeps increasing as the size goes down, and even 500,000 is considered risky. But market's changing, beliefs are changing. We think that 10 years from now, nobody will consider a 500,000 person market to be risky, simply because in the same way that these smaller secondaries were considered risky 10 years ago, right? And nobody worries about investing in secondary markets anymore. In fact, even the institutional guys say, maybe we don't want to invest in primaries anymore. So everybody's got their favorite secondary market to invest in. One of the markets you like, Raleigh, is actually now an institutional favorite. Nobody would want, institutions were not thinking that Raleigh was a market that they wanted to invest in 10 years ago. So clearly attitudes change over time. Clearly the way people think change. And we think that over the next 10 years, people are going to start looking at these 500,000 person markets. Obviously, a big part of that belief is that we are now seeing conclusive proof that for even red state markets, we are not seeing a reduction in work from home. So obviously we had this spike in work from home that happened in 2020 and 2021. The red states came down much faster than the blue states. But ironically, both red states and blue states pretty much came down to the same level. And then the last year, it's been flat. And what's nice is it's been flat at a level that is much, much higher than pre-COVID. So pre-COVID, between 8 and 9% of Americans were working from home, and now it's in the low 20s. And that average, the difference between red states and blue states is only a couple of percentage, right? So blue states are a little bit higher, red states are a little bit lower. But point is, it's in the 20% plus range. And that has fundamentally changed the way people think about housing. And that's where we come to our second premise, and I'll tie it back to Chattanooga in a minute so we can go back to the property. But fundamentally, what has happened is that, in 2013, 45% of Americans could afford to buy the median home that was on sale. Today, that number is 16%. So, we went from almost half of Americans being able to buy the median home to 1 in 7, right? And this is, by the way, the worst it's ever been. The affordability crisis is the worst that's ever been. And the reason for that is straightforward. 44% increase in home prices since COVID started, 4 years, right? 44% up in prices. And then the interest rates have more than doubled. So you combine those two, and now your income's gone up by 19.7%. Your mortgage's gone up by 111%. That gap is the highest in history by far. Nothing that we've ever seen actually even comes close. And so as a reason, primaries have become ridiculously, outpriced. Secondaries are now becoming outpriced. So like Denver is really expensive. Parts of Phoenix are really expensive, and so are parts of Dallas. So we're now seeing secondaries get priced out because that gap is so ridiculous, right? 111, versus 19.7, that people are now looking at tertiary markets and investing into tertiary markets. And so when we looked at lots of different markets, we're interested in low tax regimes, and that's our third tenet, by the way. That our third tenet is previously the United States was getting split between blue states and red states. So money was moving, people were moving from blue states to red states because they desired lower taxation levels. Now something different has happened. The red states have started to increase property taxes at a ridiculous level. And like Texas is a perfect poster child for how insanely high property taxes are, making it almost impossible to make money on a property in Texas that you bought in the last 3 or 4 years. And so the new tenet, which I haven't heard in podcasts, and I'm sure it'll happen sooner or later, is that the money is now going to flow to states where property taxes are low and insurance is low. So then, it's not red versus blue anymore. That was the last 10 years. It's which state has the combination of low property taxes and low insurance. So I'm no longer investing new properties in my favorite state, Texas. And it's like, Texas was wonderful. I still have properties there. I'm enjoying them. I'm not buying anymore. And I'm not going to buy any more because I don't think that the property tax and insurance problem is fixable. Insurance, if anything, is going to keep skyrocketing. And property taxes, a state cannot change its property taxes without radical action. And I don't think that radical action is going to happen in places like Texas or other high property tax states. So ironically, where we used to chase growth, we used to chase growth above all else, right? So population growth, job growth, income growth, home price growth. And obviously that points to Texas and Florida and a few other markets. We don't chase it anymore. We now chase low property taxes, low insurance, smaller markets. And when we look at that and we profile about 10 of those markets in the United States, Chattanooga is in the top 3. And so we loved our property in Dalton. Ironically, that was a property that we have now sold once and then purchased back. So Dalton is about 30 miles from Chattanooga. It's a sort of an upscale suburb. Property was called Park Canyon. So we owned it between 2018 and 2022, sold it, then bought it back, and are holding it now. Happy with the first time. Well, our investors were, delirious with the returns on the first time. Also happy with the second time. And so we learned a lot about the Chattanooga market, the good, the bad. It's not a perfect market. And so we were like, we want to keep growing in this market. And so people knew that we own property there, just like, you guys, I'm sure Dan Hanford gets calls for North Carolina. Well, I get calls for Tennessee. And so somebody called us and said, hey, there's this property and there's this guy, he owns 30 properties and 5 of his properties are in trouble, ironically in Texas. So his properties in Texas were in trouble and he needed to basically put huge amounts of money into them. So what he was doing is selling off some of his properties that were fairly stabilized that he normally wouldn't sell with me. There was no real reason for him to sell this property. When you look at his T12, it's like, why would you sell this at this time, right? I would have just waited for 2 or 3 years and sold it at a lower cap rate. But I think the guy needed to recapitalize his properties in high property tax states. And so this property basically was the sacrifice that he made. And, I'm sure he did well because he bought it a long time ago. So this property was owned by him for 7 or 8 years. So he's already making a huge amount of money on it. And so what we loved about the property, and this is the reason, this is not a tenet of ours, it's a mandate currently. So as you can imagine, like most other syndicators, we have a 2-person acquisition team. So there's a director and then there's an analyst. Currently, they do not get bonuses at all if we close on a property that does not have a loan assumption. So it's still they're part of their job. They still have to close on a property every 4 months. But if that property doesn't have a loan assumption on it, they don't get a bonus. And so they're really, really motivated to look for properties with loan assumption. Now, what was amazing on this property was it was a loan assumption, but it was a very high LTV loan assumption. The property's loan, which was it was a 5% fixed loan for 4.5 more years. So the story is really all in the loan. It was a 79% LTV, which meant that there's no supplemental. So not only did we assume the primary loan, we didn't get a secondary loan. Because to buy a $30 million property today, if you buy a brand new $30 million property without an assumption, you need between $13.5 and $14.5 million in equity. That's a lot, right? Because you also, acquisition fees and, you're operating all of the other stuff. If you want a fixed loan, then you basically have to put a lot of money in there as well. We closed on this property and our total raise was 9.8 million. That is, if you look at 100 properties that have closed today, you will not find one that's being purchased for 30 million with less than 10 million in equity. That is an extraordinarily rare occurrence because of the nature.
So were you doing any value add to this property? Was any part of the, 9 million part of, raising to do repairs, anything like that?
$1.3 million. So it's $1.3 million. There's some work to be done on the pool. There's some work to be done on the outside, retaining walls, stuff like that. And then usually the inside. So the property's about half rehab. So, the weakness of the property, if you want to call it that, is our business plan is 194 units. We're only rehabbing about 70 or 80 units. We're not rehabbing 120 units, because of a lot of the property is already rehabbed. We think it's already rehabbed to the right level. We may change our mind on that. And if we do, we'll just raise some extra equity, or we'll raise some pref equity a year from now and, do our rehab. And if there's a possibility of refinance, then we'll cash those people out. So we've got some options in the future. What we don't have as an option in the future is to sell the property in 2 years, because this property has a loan defeasance and it's going to be pretty punitive to sell the property in the next 24 months. So it's not a flip. We've all done flips. I love my flips, and the stuff that we've done in the last 2 or 3 years was, legendary, but nothing to do with us, just the market. We look like heroes, but it wasn't anything to do with us. This is not a flip market. This is not a flip property, because the property at this point has 57 months of loan left on it. And so we've told our investors, hey, we're not selling for the next 57 months. We might sell in the last few months because the loan defeasance, shrinks to a small amount. So you can just pay the penalty and get rid of it. So the plus of the property is extraordinarily high leverage. 79% leverage in this market is unheard of, because most people are struggling to hit 65, which means that the total amount of equity that we're putting in is very low, which means that the cash flow is very high, right? Because there's no supplementary loan, and we don't have any, we're not paying for a rate cap, right? Because it's already
What's
fixed rate.
the interest rate on the assumption?
5.2. So it's not one of those. I've seen people buy properties with 4%, assumptions. What I'm finding is those 4% assumptions, the price is high. People are almost paying, they're not getting that 25, 30% discount that I desire from today's market and today's cap rates. They're paying a 10% discount. But it's a, it's a trade-off. They're getting a 4% interest rate, so their cash flow is high, but then they're paying a significantly higher price than they should be for in today's market. So it's a trade-off for sure. And I like the middle nature of this trade-off, which is very high LTV, no supplemental loan, no rate cap. And then I've got a 5.3% rate. Today, by the way, if I was to close on this property today, it's almost impossible to get a rate below 6.4, 6.5. So it's a $23 million loan, and the delta between 6.4 and 5.2, that 1.2% delta is $275,000 of cash flow. Another way to say that is, well, that's 2.2, about 2.75% cash flow for investors. So if you're investing 100 grand, I'm now giving you 2,750 a year in extra cash flow. So it's a fantastic trade-off. Obviously it's a high cash flow property. On the downside, I'm only rehabbing about 80 units. So I'm only getting my rent bumps, which are about $157 on those 80 units. What's nice is they've already gotten the rent bump on the other units. So it's a proven rent bump. It's not like, it's some properties you see they're early stage, they're not rehabbed, and they've rehabbed them and then gotten a rent bump on 10 units. Well, honestly, that doesn't tell me anything, because anyone can get, rent bumps on 10 units. That doesn't mean that the market will support rent bumps on 100 units, right? 10 is not the same as 100. In this case, though, they've already rehabbed more than 100 units. They've already gotten their rent bumps. So my rent bumps are proven, but my total rent bumps are fairly small, keeping in mind the size of the property. So that's the negative that I have to live with. And that means that this is not a project that I can get rid of in 3 or 4 years. It's going to take a good 4.5 years. And probably at 4.5 years, I'll sell it as opposed to refinancing it.
All right. So it seems like a lot of the value is in the hold in the business plan in the loan assumption. I'm curious though, when you did get this call and this person who needed to sell this property, and you go to do your due diligence, first of all, how did you structure the contract, and how did the due diligence actually go on the property?
So the seller, I'm not going to name him, is known to be a rather difficult person to deal with. So we were given the heads up by our local friends. Hey, this guy owns a bunch of properties here. He's known to be a very cranky gentleman. He's very rich. He's not going to come back and rescue you. So when you create the offer, know that this is what you're getting, and you will not get one more inch from this guy, not one more millimeter from this guy. So at the the initial negotiations with the buyers, with the sellers, were, let's just say, aggressive, not fun. Neither party was courteous. It was it was one of those, no, 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 you have to give us this, and no, 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 we won't give you this. And it was basically one of those horse trading sort of things. The property, he had tried to sell it before and had come back to the market. So one of the things in our favor was he didn't want it to drop out a second time, because a property that goes to the market a second time and drops is tainted. Nobody wants to touch it because everyone's fearful of what's wrong with the property. So we had that in our in our pocket. Um, and so we weren't sure about, raising $9.8 million in this particular market, because what we've seen, Whitney, is some raises go really well and some get stuck, and it's unclear why that happens. It's just been a little bizarre, right? So we've been able to raise plenty of money. We just raised, 5 or 6 million for something else as well, but it's been up and down. And so we were a little nervous. So we wouldn't agree to the 90-day close that he wanted. We gave ourselves 30 more days. Of course, he got $100,000 in non-refundable additional deposit for that 30 days out of us. But and he wanted it to apply to the property price, which we said, hell no. So we just kept going back and forth. We didn't want to lose the property because that kind of loan assumption is extraordinarily difficult to find. And so instead of saying no, we just kept saying, we can't do that. We can't increase the price, you know. And so he was able to get that additional deposit up from $50,000 to $100,000 to give us that last 30 days. But we had 120 days to close, and it took us about 95 days to close. And the reason it took that long, the raise went well, is because we had about $3 million, $3.5 million in 1031 money. And some of that 1031 money was coming in from a very profitable property that we just sold in Atlanta called Equinox at Night. So that was a 2x plus. So there was quite a bit of 1031 money. So we had that money in there. Then we had another investor in there. And when you have 1031s going into these properties, the closing is a nightmare. Everyone has to do it at the same time. And all these tenant in common structures have to be created. So I think that, we would have closed at the 65-day mark, not at the 95-day mark, if it hadn't been for the 1031. So it took a long time. But because we knew that the seller was a very, very difficult person to deal with, all the negotiations were done upfront. And it also meant that the moment the property was in contract, we were sending armies of people to the property. We do pay a third party to do professional due diligence for us. That's something that we've always done. We feel like our people overestimate their ability to do due diligence. So we pay third parties to come out and do the due diligence. We obviously are with them, right? So it's fun to be with them. In this case, we had two people from our group. Both the director of acquisitions was there. He was the one that took the videos that go into the deck. It's very important to take those videos. Your raise velocity decreases if you don't take physical videos at the property. So we always do that. And we don't just walk the property in the videos, we also walk the neighbors. So, it's like, behind me, you can see on the other side of the street, brand new 52 townhomes just being built on the other side of the road from Midtown Bridge. So you can see that this is an upscale area where people can actually afford, townhomes. And those townhomes were $2,800 in rent. So they were expensive, large, 1,800 square foot townhomes. So that's obviously gives confidence to people that are investing. So the team went out there, we paid the due diligence people. Property didn't have a lot of challenges, to be honest. And I think the reason for that is this, and I don't know if this is other people's, you should know more about this, Whitney, because you get these sad stories a lot on your podcast. But when we have a rich owner that owns 20 or 30 properties, we rarely find very serious and major problems. They just fix them. And that's the nice thing about buying from these rich guys. They keep their properties fixed. So it's got some issues with the pool. It looks like that pool motor is broken, and they are using the jacuzzi motor to heat the pool. So we'll have to figure out what to do there. There's a few other things that we need to look at, but it wasn't the sort of nightmares that we've had with other properties. And the challenge, of course, was $200,000 hard on day one. So you're just hoping and praying, because if something bad happens and this kind of a crusty owner will not give you anything, he's going to just say, hey, I'll just keep your $200,000. So you're just praying that nothing bad happens, because then you have to just lose $200,000 and walk away, and all that work and travel goes to nothing.
Well, tell me how you structured the deal for the investors. We heard that part of the raise included the 1031 money from a previous sale. For those funds that you raised, how did you structure the deal for your investors?
So we had, if I remember correctly, you know, the investors could invest 75K, 125K, and 200K. Those were the three tiers. So 75K minimum, and that gives you a six pref or preferential treatment. The splits were all the same, 70-30. So 70 for them, 30 for us. And then we had a bonus tier, which I think is once the property hits a 20% average annualized return, it switches to 50-50 for anything above that. So the first 20%, they first get six pref or seven pref or eight pref. So the difference really was in the pref. So if you're investing 75K, you've got a six pref. If you're investing 125K, you've got a seven pref. If you're investing 200K, then you've got an eight pref. There was $1 million tier, but we really didn't execute anyone on that particular tier. And that particular tier, I think, was a nine pref, but nobody gave us $1 million for this property, so no, it wasn't used. So it was a 70-30 split, and with a bonus tier for us once we hit 20% annualized. And one of the key things why I always suggest to people to keep that bonus tier is this. It is my fundamental belief that over the next 5 to 7 years, all advanced economies in the world will suffer from a bout of high inflation. I'm not talking about hyperinflation of the Turkey or Argentina type, but I'm talking about high inflation. And it probably will be for about a year and a half. And you could say, well, we just had it for a year. No, I mean higher than this, right? So if that occurs in the next 5 years and you're holding the property, then the property will make so much money on sale that you will be really, really glad that you had a 50-50 bonus tier.
Wise words for the general partners here that are listening to the show. Neal, tell us what kind of, on the GP side of things, what kind of fees did you charge to this project?
We charge a 2% acquisition fee. So $30 million is about 600K. We charge a loan fee. So that's a 1% loan fee. I'm the only guarantor on the property. That's it. I think, two asset management fees, I think are 1%. So 1% of total equity is our asset management fee. So 9.8 million means about 98,000 a year. To be honest, we don't usually charge asset management fees in the first couple of years of a property. We just defer them. So it takes a while for the property to be on its legs, and I don't want to add to the property's cash flow problems by charging 100 grand a year. So pretty much every property that we've ever had, we just defer that asset management fee for a couple of years. When the property is in a good place, either it's refinanced or it's been sold early, that's when we get our asset management fees.
Well, Neal, thank you so much for sharing your knowledge and expertise with us here today. Before we wrap up, I've got two questions for you.
Sure.
What did you find that was easy on this property that you thought was going to be a little bit more difficult? And then what did you find that was hard on this property that you thought honestly would be a little bit easier?
The equity raise was easier than I thought. We were bracing for a tough equity raise and it just sort of flew by. And I think the biggest reason was we were very good at pointing out to people that this was an extraordinarily high LTV, resulting in significantly higher cash flow. That was the difference from our previous property, which didn't have a LTV this high. So lesson learned there, people at this point are really, really sensitive to cash flow more so than they were before, when everyone was high flying and the prices of properties could only ever go up. And we were living in this Barbie world, and now we're back in the real world where people are really looking at the properties and saying, hey, does this produce significant cash flow? And so it was much, much easier to deal with that. What was hard? The 1031 was a nightmare. Basically I used up 2 to 3 months of work from my operations team. My acquisition team had to jump in there. Obviously my investor relations people were in there, but what's been told to me is, Neal, we got to raise this minimum for the 1031s from 250K to like 500K or a million. It's such a nightmare. You have to corral all these people. They're all on vacation. They all have to sign together. There's all these entities that have to be created. So I received a great deal of flack from the team for basically keeping the 1031 minimum to as low as 250K. So lesson learned, next time will be 500K.
So were these for outside 1031 exchanges, essentially
Yeah, these
tips?
people that just, had sold whatever it is that they were looking to sell, some kind of real estate, and the window of closing, matched up with their dates. Um, and there's people that approach us all the time because we have in the past sold fourplexes and duplexes from projects that were new construction. So we have a bigger 1031 pipeline than most syndicators do, because people have come to us that are really interested in owning their own assets. And so that's a portion of our database that's rather unique. And so those people, they're usually trying to buy their own thing and they're hedging their bets. That's the nightmare with 1031 is, what if you have a big $2 million 1031 and that person is basically has you in second position, and at the same time they're looking to buy something else, and that something else closes. Now you've lost $2 million 2 days before closing. So understand that 1031 is a double-edged sword. It gives you extra money, but very often people jump out like a week before closing. So in our case, my company now has a cash reserve that we hold in case of these kinds of things happening. But if you don't have a couple million cash reserve, you should be very careful taking, $2 or $3 million from a 1031 person, because they almost always jump out 3, 4, 5 days before close.
1031s can be definitely very tricky. And so we haven't really ever covered that on the show. So thanks for touching on that. Neal, if
Yeah.
listeners want to learn more about you, how can they do so?
I think the best way is to look at our analytics. So we publish a very large amount of data on a website called Multifamily U. It's multifamily followed by the letter U. It's multifamilyu.com. It's free. It's always meant to be free. There's no subscription, no upsell, no education, training programs, coaching programs, nothing of the sort. And we, don't intend to make this site anything other than a community where, real estate analytics and data and information about which cities to invest in is gathered. That's probably the best place to engage with us. As I mentioned, about 25,000 people using that data. Only about 1,000 are investors. You probably get an email from us 4 times a year inviting you to our investment events. And if you want to, ignore that, just click delete and continue focusing on the data that we provide. Multifamilyu.com.
Awesome. Neal, thank you again for your time here today. We look forward to hearing about your future deals.
Sounds good. Thanks for having me on again.